The European Union agreed on Thursday to force investors and wealthy savers to share the costs of future bank failures, moving closer to drawing a line under years of taxpayer-funded bailouts that have prompted public outrage. After 7 hours of late-night talks, finance ministers from the bloc's 27 countries emerged with a blueprint to close or salvage banks in trouble. The plan stipulates that shareholders, bondholders and depositors with more than €100,000 would share the burden of saving a bank. The rules break a taboo in Europe that savers should never lose their deposits, although countries will have some flexibility to decide when and how to impose losses on a failing bank's creditors. The final agreement marked the end of a complex negotiation following a failed attempt to reach a deal last weekend. Swedish Finance Minister Anders Borg was among those who declared himself satisfied with the new bail-in proposal, which looks to investors to fund failed banks.
Well, we have seen a substantial increase of the flexibility in comparison where we are at midsummer night. In particular for Sweden, we now have a bail-in proposal where risk-weight assets of 20% will be the criteria, which was a key point in our negotiation. So for us, this is a clear step forward.
Under the rules, which will come into effect by 2018, countries will be obliged to distribute losses up to the equivalent of 8% of the bank's liabilities, with some leeway thereafter. Europe can now focus on building the next pillar of a project to unify the supervision and support of banks in the Eurozone, known as Banking Union. But thorny issues lie ahead, not least whether countries or a central European authority should have the final say in shutting or restructuring a bad bank.